Hi, this is Parik Sam with this episode of Living and Working Abroad. Pandora's box, Panama Papers, what's it all about? Is it some big conspiracy? The answer is possibly. What a lot of people have done is taken care of their family and business and their family assets, their property, their investments, and put it into a tax shelter that protects it from higher rates of tax, possibly in their home country. Now, there are other reasons that people may have done that. Some might have been what are called illegal because it's money laundering or it's some sort of other financial fraud. I've got no sympathy for those people, and that is okay. But the point is that there's legitimate reasons behind doing what they've done, and this is why a lot of people will say there's no evidence that we've done anything wrong. We haven't done anything wrong, and yet you see in the inflamed and passionate media, everybody's being tarred with the same brush. If a UK family owns property and business that's worth more than £325,000 on death, they potentially got a 40% inherited tax liability. The principle of tax planning is that you pay less tax and that more of the assets pass to your family rather than the taxman. So we're not here to break the law, we're not here to evade taxes. There are some companies that have for many years used the offshore tax system and the cross-border tax system to exploit events, and individuals have done that for different reasons. But protecting your assets is a legitimate thing. You wouldn't go out of your front door without locking your house to protect the assets and things that you want to keep safe. So how can we do that? Now, is the rules of the game changing? Maybe, but doing things the right way to protect your family and business is still a legal way of going forward. So in the UK, the inheritance tax laws under English law allow for gifts to be made during your lifetime free of capital gains tax, free of inheritance taxes. British expats can sell business while an expat in the UK, sell assets and have a deferred capital gains liability. That is a choice of the government system there, and one that can be used. So there are many good uses for this. In some countries around the world, you cannot buy property unless you've got a local partner. So what's going to happen to that asset when somebody dies? Then the locals are going to get hold of it, and you can be charged 10, 20, 30% of the assets can be lost because they're not protected and not sheltered elsewhere. And so when you're working cross-border, when you're investing cross-border, when you've got a global business of any description, when you've got assets in different locations, you could have relatives in America, relatives in Australia, relatives in the UK, relatives in Europe. All of that creates complication in the terms of when you want to make gifts, when you want to leave inheritances, and when you want to manage an asset in case something goes wrong with the family. That you have an accident or sudden health condition that stops you managing the money properly. All these are expensive interludes, and to protect the money, then the reason you use is a trust. That's the basic principle about it. So from the Crusader days, the knight would go off and put his estate in trust of another person to look after until he returned. So that principle is a sound principle. And if it gets some tax benefits, that's a secondary one. But generally with trusts, the tax benefits are not that great. What a trust does, it protects the asset from expensive probates, administration, certifications, or taxes because of a cross-border entity. And that's what it does. It gives the family can control that trust from a distance without the cross-border conflicts of tax and trust and legalities coming into place. The underlying assets will always be taxed. So there's three types of taxes generally. There's income taxes, capital taxes, and inheritance taxes. The inheritance taxes are capital taxes, but they're paid on death. Capital taxes are paid when you sell property or when you sell a business. And generally they're unavoidable. You can, if you've got money that you earn through your business, then good for you. And the great thing about operating through a larger business or even a personal service company is that generally around the world, companies have a flat rate tax system. So if you can pay a flat rate 12.5%, 15%, 19% corporation tax, that's better than an increasing personal income tax level of 45% or more. So by splitting the income between dividends and corporation tax and income tax, you can still pay a good amount of tax, but not as much as you would do in another jurisdiction. So there's ways to get around it that manage your income and your assets to protect them so that your family benefits and not the taxman. For more information how to protect safely your property and business assets across border, contact us at proactpartnership.com. Got lots of webinars and insightful insights of how to look after and protect your family and protect your business and not get yourself exposed by a general data jump and not get mixed up with the people that are doing the wrong things for the wrong reasons. proactpartnership.com or chat with us live at proactpartnership.co.uk and tune in, and we'll see you again next time. Thank you.